Q3. Hello, everybody, and welcome to our Q3 market update for HLC Equity. Just going to give a couple moments here so that we can let people come in and start joining, and then we will get this started. Thank you very much for joining us today. Okay, see just a couple more people that are coming through, so we're going to let them join, and then we will begin. Our market update. Okay, well, welcome again, everybody. Thank you very much for joining the Q3 HLC Equity Market Update for 2023. Appreciate everybody joining. Our goal for this webinar is just to give you a kind of high-level view of different aspects of the both the economy and the real estate investment business that we're seeing. Before we get into the details of the webinar, I just want a quick disclosure that nothing in here is financial, tax, or any sort of advice. It's just our overall kind of the way we see things. Everybody is encouraged to use their own consultants and advisors, and we of course are not offering to sell any securities through this webinar. Okay, so our discussion is going to be with three members, myself and David Molitor, who's our head of operations, and Cesar Nguyen, who's our director of acquisitions, as we usually do on these quarterly webinars. Hopefully, we'll be able to give a wide range of views from what we have really been seeing, kind of given everything that's going on in the world and the economy. So I just want to give kind of a high level from a macro environment. So I've just chosen some 6 kind of select themes, and obviously these aren't the only themes, but just to give an idea of things that we're discussing, both when it comes to the real estate investment market and when it comes to the overall economy. So these are kind of the themes that we find very interesting and that we're kind of exploring and also have our eye on that could have broader impacts on the real estate investment market and the overall economy. So for one, you have office. Obviously, since coming out of COVID, office has took a big hit. This last few weeks, we had the bankruptcy of WeWork. To give you an idea, WeWork utilized roughly 20 million square feet of office space as of June. So, the question is, with an already extremely challenged office market, what will happen to all of that space? Particularly in the new environment with the lower demand for office space. And obviously a lot of their locations are very prime locations, but they're also locations where there's a lot of challenges as it is. So this is something that, it will particularly even add more pain to the office market. One bright spot is we're seeing more government initiatives to help fund office conversions. So office conversions are highly challenged. When it just from a financial economic standpoint, it's very hard to make them economically viable, but we are starting to see that the government realizes that, and they're starting to set up to initiatives that will help with that. And that's really the only way that they can become economically viable if it's through government incentive programs. At this point, some office buildings in major cities are worth less than the land that they're sitting on. And the conversions to apartments are few and far in between. So for instance, it's projected that last year developers were only able to create 3,575 apartment units through conversion. And that amounts to less than 1% of the overall apartment unit built last year. So, you can't make a huge dent with conversions, but hopefully there may be some ease if governments are able to create viable incentive programs. On top of that, we have retail. Retail has its challenges, but it also has its positive spots. Rent growth overall in retail has definitely slowed, but there was a recent JLL report that cites that it's due to primarily to a lack of supply in high demand locations. And so the report emphasizes that the primary challenge in retail today is the lack of supply in these prime locations, but the demand for quality space is still present. So I'm going to touch on this in a little bit later as well, but that's just an interesting anecdote that we've seen. Obviously, we have our being that real estate is so highly correlated to interest rates. We have our eye on interest rates, and so a question that we're kind of continually discussing is the 10-year Treasury. And like most people, we are constantly monitoring the movements in the 10-year Treasury. So kind of a key question for us is, we're just trying to figure out where the 10-year Treasury shakes out. Will it need to get up to 6% range in order to tame inflation, or will it be able to settle in, and hover at 4.5% to 5% range? And the difference between those could have profound implications on real estate values and portfolios. And then another theme is they're starting to see kind of breaks in both the rental market. So you have a declining rent environment kind of overall, but that's not that it, as a whole picture, that is correct, but there are certain pockets where there's actually some growth, and we're going to cover some of that. But we're preparing for possible rent declines that could come as a result of more challenges in the economy. So in all asset classes within commercial real estate, there's really some sort of exposure to rental declines. We're seeing rent softening in certain areas, and it creates challenges for real estate investors because, on the one hand, you have rental rates declining, and on the other hand, you have an inflationary environment, and yet the declining rents may not be able to offset the expense growth like it used to. But interestingly, there are specific markets where multifamily rents have actually been increasing. Caesar will touch on that a bit later, specifically in the multifamily space. Then we have something that's starting to break that we're starting to see. There was a big article about it in the Wall Street Journal, but it's something that we've also seen through our industry data, is that there is a lot of mezz financing. So kind of a lot of the bridge debt that has gotten done between, in the capital stack, primarily the mezz piece is starting to crack. You have increased rates and reduced values, which is creating a series of defaults in the market. Tracking mezz volumes is challenging because they're not recorded on property records. However, interest rate increase continue to impact the real estate market. And this area of the capital stack, the financing, this capital stack, it's among the first to see many kind of larger scale defaults. A year and a half ago, mezz debt was roughly around 10 to 12%, and now rates are above 15%. So when borrowers go out to try and refi, they're going to have a very challenging time, especially given the fact that senior debt rates are so expensive as well. And then the last one that we have is the obvious impact of war and wars. So, obviously there's a new war in the world, and that is on top of, a war that already existed. So speaking beyond the impact on the human side of the two current wars that are going on, there's obviously the economic impact. Really what this war and an expanded regional war will do is amplify the existing challenges that already exist. And the war in Israel has grabbed the eyes of the media. That this obviously comes at a time when the Russia-Ukraine war has already had a significant impact on the global affairs. So while that war has impacted the energy markets, there's a strong likelihood that Israel's war against Hamas and possibly other actors will lead to further instability in the energy markets. So just as an example, at a time when everyone would prefer to reduce the price of oil, the World Bank recently stated that they feared the current war could create a global economic shock that could drive oil prices up above $150 a barrel. And obviously, wars have additional impact on the broader economy, such as increased food prices and other commodities. And this all comes at a time when we're trying to tame inflation. And all of this is, of course, only factoring in the current situation, not including a broader regional war, which obviously could have much larger impact on the global economy. So again, these are a high level, some items that we're kind of, that we have our eye on from a macro point of view. And now I'd like to go into from kind of on the ground, pure real estate investing in the acquisition side first, what we're seeing. So I'm going to ask Caesar to now tell us a little bit about what's going on the acquisition side of things.
Sounds good. Thanks, Daniel. Yeah, so on my end, it's quite challenging on the acquisition side to look at deals, and we have a multiple factor, both headwind and tailwind. So I go to headwind first. Obviously, the 10-year treasury, the treasury is the biggest issue here. Is, in Q3, the 10-year jump 80 bips from 3.8% to 4.6%. And that has a huge impact on acquisitions because, in Q2 of 2023, we were going out and putting offer, and we were within 5 to 10% difference between our bidding prices versus asking price from sellers. And because of the 10-year jump up 80 bips, that gap widened in Q3, to 20 to 25% difference. And that's essentially shut down the market. There was no trade going on, very little activity. All of the trade that happened in Q3 are with deals that had loan assumption options, essentially buyer that accepting lower leverage deal, but want to lock in long-term fixed rate debt at 3% or sub 4%. So those are all the deals that we see. A lot of that is family office, as well as private equity fund that have that need to deploy capital. And then so this transaction volume go down 66% year over year in Q3, and I expect that will continue into Q4. However, I've seen a lot of deal volume come through my desk lately, which I think that translate into a uptick in transaction volume in 2024. We start to see a lot of deal flow now where sellers are adjusting to the new norm. Which if you go to the next slide, I can and when I talk to investment sale broker in the market, we start to see a divergence in cap rate in different asset class. So in 2021 and 2022, class A, B, and C in a lot of this market, like Dallas, Fort Worth, and Atlanta, they all traded sub 4 cap rate. And at that point, when we saw those transactions, our conclusion that we did not get paid for doing class B and class C multifamily because there's no different in cap rate. So we pivot toward more higher quality class A asset. Now a lot of trade in the market. Class A is in the 5 to 5.5 cap, class B 5.5 to 6.5, and class C 6.5 and higher. So market is back to normal. A lot of players are pricing in that difference in quality, which is feel good. You start to get paid for the work that you have to do with a lot of this asset. On the multifamily on the absorption side, we still see decent absorptions on multifamily, partly because with the treasury up so much, it's become unaffordable for renters to buy homes. Just looking at the overall housing market, between 2021 and 2023, overall housing price average went up 30%. Interest rate doubled, if not triple, within that time, which, so if a home buyer to go out buy a home today, the monthly mortgage cost, it will be double, compared to 2021, which makes it very unaffordable to buy home, which would become a tailwind for multifamily because, usually a lot of this renter, they leave the multifamily space to go to buy home, but now they can't. So they stay renter for longer. But, as you can see, the absorption is slowed down a little bit because of the pressure on rent, and also gas and food price on overall rental budget. So we see a lot of newer Class A, like brand new Class A building that are going lease up will take much longer. We did a deal, it's a Southgate apartment building last year in April 2022. We did a great lease up, but then our competitor in the same market, they've been struggling all this time, and then because of the overall rental market. But and also the last piece of this on the tailwind side, I have to say, is with related interest rate, is that with the high interest rate, it makes it so much more difficult for development deal to pencil out. So we see a lot of multifamily permit and start have slowed down significantly. So this in the medium term, 3 to 4, 5 years from now, will create a tailwind for multifamily because we know supply coming online, and that would help drive rent growth for multifamily. And being this space is great because the U.S. housing market is still structurally short about 4 to 5 million units. Depends on what measure you look at. If you go to next page, what we see in our competitors. So here is the chart that CBRE did for cap rate survey. So within the last year, since Q3 of 2022 and until now, going in cap rate for prime multifamily jump up 80 bips from 4.1% to 4.9%. And exit cap rate also increased about 44 bips during the same period. So what point to me is that cap rate are now approaching their peak. I still think have a bit more room to go until then, but a lot of players that I'm talking to, they are seeing the light at the end of the tunnel, so to speak. We're expecting acquisition volume will pick up in 2024. It will be combinations of distressed deal because a player that can no longer afford to hold on to asset, they have to sell because the lender forcing them to sell, and or players that they bought asset for 6-7 years, have done their renovation program, they have done adding value to asset, and now they're accepting exit at slightly less proceed that they can, but they still make a decent return to their investor, and to recycle the capital into a deal that have a better basis. So we start to see a lot more of that. On the lending side, when I talk to lender out there, they start the asset management team has been very busy looking across their portfolio. Borrower with strong credit profile will get more preferential treatment. Their loan will get either loan modification, extension to give this borrower additional time to work out their situation, either a year or 2 years. But the borrower that do not have the wherewithal to bring the right size of situation, lender will force them to sell. And we actually been bidding on quite a few of them lately, and where in a lot of this situation, the equity is wiped out, but the lender will be protected because they can still sell and recover all the costs. And go to the next slide. So what we are watching, the ELI PwC 2024 market trend survey recently came out, and to me it's more like a early Christmas present, to see how the market performed. And in this report, what I can see is the biggest theme is called the Great Reset. A lot of overall commercial real estate market, what they view is that what core is no longer core. For example, back in a decade ago, if you look at a lot of pension fund, the majority of their portfolio comprise the core asset is office and mall, and also in urban core city like New York, DC, Boston. Now that's no longer the case. The majority of their asset now are focused on multifamily, industrials, and also and also medical office and student housing. And a lot of this firm are now focusing on different market. And here in this chart here, you'll highlight they divide into 4 different major segments: the magnets, the establishment, the niche, and the backbone. The establishment is the typical market that a lot of major real estate players focused in the past. Now those guys, they focus on the magnet, which is the Sunbelt market, mainly because of A, low cost living, B, migrations, as well as lower tax, and a lot of job growth in this market. So that's where we still play. We've been focusing our time on the Sunbelt market all this time, and we continue to do so for the foreseeable future, just because of the amount of migration and demand this magnets market are providing. You go to the next slide. So in terms of what we are pursuing, we still stick to our strategy of barbell approach, income and growth. On the income side, we still look at Class B workforce housing deal that at a 6 cap or higher to achieve to get neutral leverage going in and drive higher cash on cash to our investor. And on the growth side, we tackle Class A new apartment from developer that have upcoming loan maturity that they need to sell. It's harder to source and harder to come along, but once in a while we'll find a good deal like that where this developer, they have deal already under construction and they need liquidity to be able to support those deals. Thus, they need to sell off asset in their portfolio to bring more equity to the table. And what we also have done within the Q3 is expand our search to include other secondary markets with limited new supply, because we see that these are attractive market where we come in with higher cap rate and higher yield, but also because of the new team today where a lot of firms are allowing hybrid work. A lot of people, they don't no longer have to live within the city limit. They can live 30, 40, 50 minutes outside of the city limit and commute to work, 1 or 2 days a week, 3 days a week. And that will benefit a lot of the secondary market. So on the chart on the right here, you can see this is from RealPage. In September 2023, these are the top 20 market that have the largest year-over-year rent increase, above 4%, and 19 out of 20 are secondary markets. The only one in here that are not secondary is Jersey City, because of proximity to New York, and a lot of renter from New York to move to Jersey City, for lower rent and more affordable. So that's where we're spending a lot of time lately, talking to local investment sale broker to source deal in this secondary market. We came close on one, and hopefully, the seller will change their mind and come back to the table with us. But we very, on our end acquisition, overall team is that I'm very excited on opportunity that we will see in either Q4 or the first half of next year, because we'll buy at a good basis. With real estate, buying right is a key. You can only buy right once and always refinance multiple times. So buying at the right basis will essentially dictate how your investment is going to go. So that's it from my end on acquisitions.
Okay, thank you very much, Caesar. Appreciate it. We have some questions coming in, and we appreciate all the questions. We're going to try and get to as much as we can, as many questions as we can, at the end of this webinar and at the end of the presentation. So please continue to send in any questions that you might have, and we're happy to discuss them at the end. But now I'm going to ask Dave to discuss, give an overview of what we're seeing on the operational side. Please, Dave.
Sure. Thanks, Daniel. And Caesar, kind of building off of both what Daniel and Caesar said, I'm going to provide a bit of an update on what we're seeing in the DFW market and our operations specifically during Q3. My first slide here decided to kind of focus on two items. It's the occupancy rates and the market rents in the DFW area. So one thing I want to note is that this is for Class A and B units or properties only. We excluded Class C. We don't really operate those, so we excluded those from this presentation, and the data is from CoStar. So what you see starting off with the vacancy chart is increasing vacancy in the market. Currently, the overall market's about 10% vacant for Class A and B properties whenever you take into consider lease up properties, and around 8% or so whenever for stabilized properties. That's at the market. That's at the DFW, the broad market level. But we're seeing and kind of our submarkets is generally consistent with that. Particularly in areas where there is a lot of development activity. Currently there's around 65,000 units in the DFW development pipeline, 20 to 30,000 to be delivered in the next 12 months, and absorption rates being down. All of that is kind of putting pressure on occupancy and rents. And so as I kind of transition over to the other chart, the market rents chart, you'll see that rents are declining, not surprisingly, given the increase in supply and the increase in vacancy. We're really starting to see, a decline in our submarkets that kind of reflects the broader market. So for Class A and B properties, the market rents have declined approximately 2.7% from their Q2 2022 peak, and the trend is down. We see we're seeing more pressure on our Class A properties, which is possibly indicating that people are trading down into cheaper alternatives. However, whenever we look at our move out surveys, that's not what people are indicating. They're actually talking about moving for jobs or for location and everything. But it's hard for us to kind of pinpoint that affordability is the primary cause. Although there is some indication that's the case. My guess is it's a combination of factors, and affordability is just one component, and perhaps their job or their or location is another. So it's a trend we're watching, and obviously we're reacting to in our markets and at our properties where we're seeing increased concessions and falling occupancy rates. So if we want to kind of drop down to the next slide. Yeah. So this is some specific areas within the HLC portfolio I want to update you on. So as far as physical occupancy goes, in Q3 we had a pretty healthy portfolio average of around 95%. However, I think it's important to note and noted in the slide that we saw a significant variance between our properties, as our Class B properties were generally in the upper 90s, as we saw strong demand for them, and our Class A properties were kind of in the lower 90% range during the quarter. So there's that divergence between the two classes of properties, and so in some cases it's it's a more challenging environment for our Class A properties. As far as economic occupancy goes, due to the concessions and the increased vacancy, we saw an increase during the quarter of from 7.8% to 9.1%. That's a pretty significant increase in one quarter. And it's kind of reflects the market softness that we highlighted on the previous slide. And I wanted to highlight that the decline in economic occupancy is really concessions and vacancy driven. Delinquency remains a challenge, as it has been since the pandemic, really. But in our portfolio, it actually declined considerably during Q3. But concessions and vacancy increased, and that's why we saw a pretty significant increase in our economic occupancy during the quarter. Market rents, again, declining, concessions. We're seeing rather large concessions in some of our markets over a month or two, up to 2 months, I would say, for new lease-up properties that are struggling as Caesar mentioned during his presentation. Some of them are offering up to 2 months. A month is not uncommon, and certainly even decreasing rental rates is common in some of the markets, again, mostly for the Class A properties. And that's something that we're battling with daily at our properties, trying to kind of match our maintain our occupancy and stay competitive on our market rents. On this slide, we have a chart kind of shows our new lease, our rental growth for both new leases and renewals. This is a chart that we've shared previously. It's just kind of updated for the quarter. So what you'll see, starting with the new lease rents, is that there was still modest rent growth, excluding concessions during the quarter, but the trend is down. Whenever you factor in concessions, it's actually not positive. We're going backwards a little bit in our effective rents. So that's on new leases. Renewal rents remain kind of a strength for us. We continue to push renewals. It's down slightly, as we kind of expected, as kind of the gap between some of our long-term residents, what they're paying for rent and market has narrowed over the last year or two. But generally, we still have some opportunity there just because of how much the market moved in 2021 and 2022. So we're going to continue to kind of focus on renewals and trying to generate rent growth in that area. But as our vacancies have increased, we're trying to balance our renewal increases against our expirations and, more importantly, notices, so that we don't have a huge increase of move-outs in a given month and drive our vacancy down. So it's a real balancing act, in the current market to kind of try to push renewal rates, but maintain occupancy levels. Finally, on this slide, there's a chart just to kind of highlight our renewal percentage issues. Starting kind of towards May of this year, we've had kind of declining renewal percentages. Again, are probably reflecting our increases a bit. August was a good month, kind of consistent with where it had been in the previous year. But May, June, July, and September were all significantly down year over year in renewal percentages. Again, renewal increases were high during those months, but our percentages were lower. And as less people renew, there's more more available units, and then that kind of forces us to do concessions. So again, it's a balancing act that we're trying to navigate through going forward. So next slide. Yeah, so these are our areas of focus as we kind of move into the end of the year. Talk about the occupancy is always our primary focus. We subscribe to the philosophy of trying to maintain a strong or a high physical occupancy. And then we kind of use that as our foundation to push rental rates when we can. It's much easier to push rental rates from a higher physical occupancy rate than it is whenever you're lower. Even if the market shifts, you're just able to adjust faster. That's been our experience. So if in the short term we have to cut rents more or give bigger concessions than maybe some of our competitors just to maintain that occupancy, we think it's worth it, because whenever we see the strength come back, we're able to kind of really take advantage of it. So that's been our strategy, and we continue to maintain that through the end of the year. Another big time focus for us is marketing. As rental traffic has decreased, particularly in Q3, we're always kind of a little bit cautious on making any changes to our marketing mix, because we don't want to rock the boat, disrupt property traffic flows anymore. But with the data in our CRM that we're collecting, we feel like we can make strategic changes, and we have been doing that over the course of the quarter. And we're going to continue to do that into Q4 and Q1. Hopefully, reducing costs. Marketing is one of those areas where you can still, potentially reduce costs year over year without kind of losing, the traffic counts. That's the target. And then finally, the 2024 budgets. We've been working on that, and 2024, our budget process is very detailed. and it allows us to kind of focus on all of our costs for the previous year and where we may be able to make savings going into 2024. It's important to note that we have really experienced some high cost increase on a lot of items. So while headline inflation seems to have kind of slowed a bit, which is positive, we're still seeing it at the property level. Carpet, appliances, services, everything has really increased. And so in our budget process, we're looking at places where we can make savings or make changes, comparing vendors, again, within the DFW area to see if there might be some changes we can make at properties to decrease our costs based on our experience at other properties. So that's been our focus. And then also, obviously, on the big ticket items, taxes and insurance are a little less in our control, but we're actively pursuing our decreases in our assessments right now, and where possible, we're going to try to decrease our insurance expenses in 2024. So that's kind of the update and what we're looking at on the operations side, and I'll hand it back to Daniel.
All right, thank you very much, Dave. Appreciate it. And thank you everybody for staying with us up until now. And now we'll just open it up if anybody has any additional questions. One question that came in was if the year-over-year increase slide that Caesar showed, if it was for all apartments or for just A apartments. And so Caesar answered that question in the chat, but the slide is for all apartments. So thank you for that question. And we had some initial questions that were sent through. So one of the questions is, given the office surplus and housing demand, is HLC looking into conversion projects? Why and why not? So maybe Caesar, you can touch on that.
Yeah, absolutely. Thanks, Daniel. Yes, office conversion to residential has been a hot topic lately. We certainly have looked into this. We actually was bidding on a couple project, and we didn't win. But our overall view is that office conversion to multifamily is very difficult because of the limitations surrounding the floor plate. The deeper the floor plate, the worse it gets. And also the cost to convert is, office to residential is as much as building a brand new building. So it's somewhat challenging to do this type of project if you don't buy the building at a good basis. Essentially, a lot of this deal that I'm looking at, the buildings, you have to buy the building at the land basis to be able to make the deal to pencil. We have looked at some deal, talking with other operators who are going through office conversion to residential right now. And their overall feedback is that expect to have higher cost overrun because it take longer to do. And also material costs also went up. And so those are the factors that make it quite challenging to do office conversion to residential. But as Daniel mentioned, if you have tax credit or subsidy from the cities or the local, municipality, then you can make it work because of the tax basis of the subsidy. I think that's the only way I think you're gonna make it work.
Thank you. Thanks, Caesar. That's definitely very, very helpful. Another question that came in, with inflation appearing to ease and a potential soft landing in sight, how do you see multifamily activity, rents, and pricing looking in 2024 and 2025? I guess, Dave, that kind of speaks into some of your thoughts on maybe on the operational side with inflation and how we might see that impacting, rents, and then obviously pricing could correlate to that as well.
Yeah, sure. So I think, one thing is I think the soft landing is, still to be determined. I know there's a lot of talk of that, and it's, and hopefully that's the case. But as I noted kind of during, my slides, we're seeing price increases and we've been digesting the considerable increases from the past year. And so, while things may be softening a little bit as far as inflation goes, at the property level in our portfolio, it's still challenging. And Daniel, I think you mentioned, in kind of the introduction that it's doubly challenging for us because these increased costs are happening to us now, and we're not able to really push rents just because of the market environment. Most of our properties, I'm just speaking kind of at the portfolio level. Some properties we have been able to increase rents, but so we're in a sense, living off of the large increases that we were able to push through in 2022, 2021, and they were large, but our expenses also increased during that time, and they've continued to increase. Maybe it's lightened up a little bit, but they continue, and our ability to push rents has not continued at the same rate. And so that's really a tough position to be in. And and as far as looking into the future, the trend seems to at least in the near future, let's say 2024, first half 2024, I think that trend's going to continue. That's reflected in the CoStar data. It's reflected what we're seeing. It's kind of on the ground, and and certainly I don't think there's a great reason to think that that's going to change in the near term. Looking into 2025 and beyond, that's challenging to do. I will say that deliveries, new unit deliveries in the Dallas market will decline, and that will hopefully reduce the pricing pressure, allow us to kind of eliminate concessions a bit. But it's hard to that's a little ways out, and it's hard to say what else might change during that time. That could be positive or negative. So short term, I expect some of the same pressures that we've been facing for the last half a year or so to continue. And that's my opinion.
Okay. All right, great. Thank you. Thanks a lot, Dave. That's very helpful. And one other question that we have time for that came in is, will we as an HLC Equity be expecting any capital calls at all coming up? So the answer is no, we do not have any expectations or plans to. Obviously, it's a volatile environment, and we greatly try to avoid that. And so we don't have any plans or we don't see any immediate needs for that, but it's a volatile environment. Thankfully, we, those investors who are with us for any deals that had any kind of exposure to floating rate debt, some of them we were able to manage immediately and get into more secure situations. And there is one out of our entire portfolio that still has floating rate debt, but that we're managing. And interestingly, just I speak to people in the industry, and there are some groups who have 6, 7, 8, 10 deals where maturities are coming up that had floating rate debt, and maturities are coming up in 2023, 2024. So ours thankfully is in relatively a good position, but it doesn't mean that it's perfect, and it doesn't mean that there won't be things we have to do to make sure that that it's that kind of it's stabilized in the future. But to answer the question, for the immediate near term, we don't see any expectation. We don't have an expectation of a capital call. That's it, I guess, unless Dave or Caesar, you have anything to add? Okay.
No, nothing here.
Okay. All right, great. Well, we appreciate everybody for joining. Hope that it was helpful and valuable to everybody, and we just wish everybody well. And we will hopefully see you next time and speak to you soon. Thank you very much.
Thank you.